All right, let's bring in Adam Parker, Trivariate Research founder and CEO. He's also a CNBC contributor, along with Liz Young, SoFi's head of investment strategy. Good to see you both here. I mean, I guess the banking crisis that didn't fully happen is one reason that the stock market has been able to hang in the way it has. But you hear a lot of folks maybe a little confused about why we're trading at these levels, Adam, in terms of it seems like we're all clenching up ahead of a recession. It seems like earnings haven't been great, even if they've been better than expected. And yeah, the Fed's going to pause, but is it for the right reason? So what's your take on whether the market is sort of whistling past the graveyard or has it right?
I think there's 3 or 4 reasons the market's been better than people think. One, I think for sure, is the perception about the Fed getting more dovish. That's driven multiple expansion, particularly in the growth universe. I think the second is also maybe legitimate, which is the probability of a really bad scenario with really bad earnings is probably less likely now than it was at the beginning of the year. So if you think about the market as there's a possible group of outcomes, you assign a probability each one, maybe that really bad case is less likely. Some of the economic data has been stable or hasn't fallen off and even improved in a few places. I think the third reason, which we wrote about a little bit today, is maybe AI a little bit, and that actually impacting stocks more than people think. So, I don't know if it's 10 years or 20 years. I don't know if it's 20% or 50%, but I know a lot of human behavior will be totally commoditized by AI, and there'll be massive investment implications. So you can look at a stock like NVIDIA and say, it's up too much. It's up 80, 90% this year, but maybe it's just really cheap on a 5 or 10 year view as more and more things. So we created an AI basket by, doing language processing on every growth stock's transcript, and we found these things outperform growth X AI. So there's something there. There's something real. It's not all, speculative fraud. So I think there's some real reasons the market's up. But I still think the balance and the risk reward is at best, 10% up, 10% down, just because you do have, I think, a higher probability of an eroding economy and earnings than you do improving.
Yeah, Liz, I mean, it gets us right back to what was priced in with last year's decline, what's still yet to be recognized, and are we benefiting from the fact that we have been for some time anticipating, the recession to kick in or anticipating some of the bad stuff, and it's at least not yet happened.
Yeah, forever it feels like we've been anticipating. Everybody's crying wolf, self included, and no wolves have been spotted, right? So I think we're in this waiting game. To Adam's point, though, if we look out 5 to 10 years, I mean, you're not going to find somebody who says that stocks are a bad buy over a long-term period. They're always a good buy over a long-term period. I think what we're struggling with right now and what the market continues to struggle with is that in the near term, so let's say in the next 3 to 6 months, we don't know what's going to happen. And it feels like, to me, we lose another bull every day because it's looking more and more likely that things are tightening up. I think the headlines, and this is what the guest talked about at the top of the show, the headlines about deposit flight and the things that we heard about in March probably are behind us from the depth of that crisis, so to speak. But now they become, what's the availability of credit? What's the availability for small businesses? And we've heard a lot about there being less available for small businesses. So if we're looking for something to fuel economic growth through the rest of this year, I would argue we're running out of spots to find it.
Yeah, I agree. I think the run on the bank acute stuff might be over, as he alluded to. But the 2 clear negatives are, 1, loan growth slowing and will be lower, whether it's in real estate or C&I. So that whatever your economic outlook was before SVB, it's got to be lower now, apple for apple, just because, talk to people who are trying to get non-recourse construction loans in the real estate market. They'll tell you no regional bank will give them one. So clearly loan growth is going to slow the economy. And I think the second thing is we all know the duration now. We know the mismatch on the balance sheets. We've been through that over the last month. But we don't know. There hasn't been enough discovery yet in the private, credit on the bank balance sheets. And it sort of feels like that's asymmetrically skewed to negative. We were talking about that before we got on the air. So I think you're looking at it, you're saying, I don't know if these things are cheap or not. I mean, they could be expensive still once we kind of flow everything through. So I don't want to say, I kind of painted you a picture for why I think the market's up, and there's some nuggets of optimism in there, but I think the balance is at best, kind of risk reward flat, if not even negative, as we kind of look out in that 3 to 6 month view. And I agree with her. You're always going to say you're bullish on a 3, 5, and 10 because equities generally on most rolling 3, 5, and 10s have been a good investment.